Roger Montgomery from the Montgomery Fund, thanks for joining us.
It's a pleasure, Mark.
A lot of commentators in the investment industry, as well as Fitch Ratings Agency, have put a red flag up about the growth of Chinese debt and associating the growth in debt in China with that usually associated with the banking crisis. What do you think about that?
Well, there is no doubt, there is absolutely no doubt that there's a very real risk of a credit crisis in China. And we've seen that because by looking at the growth of debt compared to income. Now, historically, throughout the world, when you've had debt growing at a significantly faster rate than incomes, you either have a crisis or it's carefully managed out, but whichever way you go, you get lower growth, simply because the debt has been fueling the growth. And if you scale back that debt growth because it can't continue to expand beyond incomes, then you get slower growth. And that's precisely where we are in China today. Every time I see the debt numbers compared to the income numbers, I'm always recalling, and in the back of my head I have Carol Carpenter's song, We've Only Just Begun, singing in the background. And for Australia it has very real ramifications, and right throughout Asia in fact.
And so are you able to talk to us about what some of the ramifications are, or where some of the landmines might be with a slowdown in China?
Look, all the things that they import from us, expect them to import either less of or to import more of, but at a slower rate of growth.
So we're talking things like iron ore,
iron ore,
coal.
And for a long time, particularly 2013, people denied that there was going to be any adverse impact on the price of iron ore from the inevitable supply response, and people saw the price wasn't going down, and therefore that meant that it's not going to go down. Well, what we know is that there is no pricing power in the production of iron ore. So companies that produce iron ore, all they can do is reduce costs, but if the price drops, their margin goes down, and if China slows, their volume goes down as well. So there's a very real risk at precisely the time that supply is going to increase, that we're going to see lower prices and lower volumes. And that's a real danger for Australia. It's a real danger for our index, because our index is so dominated by mining and mining services companies. And what we may see is a complete re-rating of the stock market based on this slowdown.
And are there any other landmines that you can see as a result of?
Well, I think the dangers are an increase in unemployment in that sector. And if we see increasing unemployment in mining services, and we've already seen companies like Forge go into administration, we've seen other mining services companies give profit warnings, that combined with rising unemployment on the back of Toyota, Ford and Holden ceasing manufacturing in Australia, we could see I'll call it the unemployment of the West, or the recession of the West, migrating to the eastern seaboard, and that would mean lower confidence. But let me say this, even if we get slower growth in Australia, slower economic growth, there is no correlation, none, between economic growth rates and stock market performance. In fact, in the years where the years where the economy has grown stronger than on average, then 50% of the time the stock market has done better than average, and 50% of the time it's done worse than average. Yeah. And similarly, when growth is slow, 50% of the time the stock market's done very well, and 50% of the time it's done very badly. So you can pretty much turn off the economic commentary and not worry about it at all.
And finally, what are the road signs that you're looking at to give you a cue as to the position in China as an investor?
I'm only watching whether or not they manage this debt crisis well. What we know right now is that the People's Bank of China is now giving unlimited amounts of money to regional and peripheral banks that are already in a credit crisis. And there's been no limit on that, so it's effectively a quantitative easing, and it's quantitative easing to the power of infinity. We don't know where that'll stop. What does that mean for the country? What we do know is slower growth. So it's already started, the evidence is there. There's not something I need to watch to happen before I think it's going to occur. It is occurring right now. What matters is whether or not they manage it carefully or not. that will determine whether there is a crisis. If there is a crisis, then it doesn't really matter what happens to businesses in Australia. People will rush for the exits and sell their shares. That I see as an opportunity. If they do manage it well, it means slower growth for the economy. That could be a bad thing for the stock market, but 50% of the time it could be a good thing for the stock market. We'll just stick to what we do, which is focus on businesses with bright prospects that are cheap, and there's not a lot of them around at the moment.
Roger, thanks for that. I'm going to go to sleep listening to that Carpenter's song myself as well. So for more insights, stay tuned to our website.